Good morning and welcome to Akora Resources update on their PFS. This morning, Managing Director showcasing the numbers, the rather robust numbers for the Bekisopa project in Madagascar. At the conclusion of the presentation, Paul will field questions that have been received over the past 2 days, as well as you also have the opportunity to register questions throughout the webinar at any stage, and we will attend to those. Any questions that aren't attended today will be answered before the end of the week, and a transcript and recording of the webinar will be shared at the conclusion of the webinar. Without further ado, I'll now pass over to Paul to walk through his presentation.
Thank you, Gareth, and thank you for the many people who have joined this morning, or noon. It's noon in Melbourne, for the PFS update. The normal disclaimers. So the PFS focuses on the Bekisopa project, one of our 4 tenement areas in Madagascar. Bekisopa is a high-grade iron ore project, and it's been the focus of our work over the last 4.5 years since listing. The Stage 1 project, which we've been focusing on, confirms a 2 million tonne per annum direct ship ore project. Direct shipped ore is for the conventional blast furnace steel making, and the capital investment delivers revenues of 1.25 billion Australian dollars and cash flow pre-tax of $500 million Australian dollars. I thought I'd put those up there because as an Australian listed company, and most of our shareholders are Australian, they're 2 highline numbers that are worth noting. Going forward, the numbers are all in US dollars for the project. This slide here is the PFS financial table. It has all of the key numbers from the PFS work, and it shows very strong economics based on a benchmark iron ore price of $100 US a tonne. Mine life of 6 years, revenues generated over those 6 years from the reserve iron ore tonnes of just under $800 million, from an initial capital cost of $61 million US. And that includes contingencies and owners and EPCM costs, and all of the other activities required to get the project into operation. NPV, very solid $147 million, and an impressive IRR of 86%. The important number is the C1 cash costs, amongst all of these very important numbers. A C1 cash cost of $42, and we'll talk a bit more about what that means going forward, but it's a very encouraging, robust cash cost, equivalent to what we did in the scoping study, and well below the $100 US benchmark price that we've used as the reference going forward. Because of the extra tonnes in the PFS, we've got a faster ramp up, and the capital payback is at 1.8 years. Why do we use a $100 US benchmark price? This slide here shows the benchmark 62% iron grade price fluctuating since 2011 in the black line. The average since 2011 has been $107, and the average over the last 3 years $116. So a long-term forward price of $100, I think you would agree, is reflective of the history and certainly of the recent years' performance. Capital cost, $60 million, consistent with the scoping study. And starting at the bottom of the image on the right-hand side, and remember that we're a contract mining and contract hauling of the product to port operation, very typical for small-scale, junior mining companies to have contract mining. So mining costs of 1.2 million, capital costs. Processing costs for mobile crushing, screening, and the second mobile unit, including magnetic separation step, 4.8 million. Facilities, this is maintenance facilities, administration facilities at site, but also accommodation facilities for employees that are going to have to come to the remote Bekisopa site to ensure ongoing operation of the mining project. So those facilities there, accommodation, canteen, medical and the like. Roads, significant number there on the roads, around 29 million. Then the port, and pleasingly we're using the existing port facilities because of the progress made with the new road funded by the World Bank. EPCM costs of around just over $6 million. And also in the capital costs, the government's 3% social fund defined in the mining code, 3% based on the initial capital expenditure, and then contingencies of just over $7 million. So in total, $60 million of capital costs for the project to get us into operation. One of the things to remember about Bekisopa is the DSO is at surface. We've got outcropping at surface, but in that figure on the right, it's the trench. You can see lump and fines iron ore. The geotechnical work has shown that this is rippable. We just have to get in there with shovels and excavators, dig that up, crush and screen to produce the product for export. So like I said, a very simple process flow sheet. An open pit mining operation, no drill and blast, dig and rip, in-pit crushing. And as we get into the second, third year of mine life, some of that mine material will go through a second in-pit crusher and be upgraded with a magnetic roller as part of that in-pit crushing stage. And then the lump and fines product, road haulage to port at Toliara, and then exported to customers. And in our PFS, we're focused on India as the near neighbour customer. That is an iron and steel industry that is growing dramatically in recent years and is forecast for a significant growth going forward. So our shipping costs are into India as part of the operation. Over the life of mine, the DSO operation will deliver 40% lump and at 61.8% iron. So pretty much on benchmark grade, and 60% fines product at 61.4%. So high grades, good quality, lump and fines iron ore for the conventional blast furnace steel making process. C1 cash costs of $42 per tonne. So very consistent with the scoping study. The operational cost breakdown, like I said, it's a contract mining operation, $4.40 to mine the ore, any waste that is there. The stripping ratio is 0.5, so very low waste removal over the life of the mine. That mining cost at $4.40 also includes all the ancillary equipment for ensuring the ongoing operation of the mining activities. Processing, $2.30, hauling to port at $24, and port and transshipping, $8 to $9. The operating activity at the port is from the port stockpile, load onto a barge off the existing Toliara port facilities. That barge then goes out to an anchoring point and using, in the initial years, the ship's gear to unload that barge into the hulls of the bulk vessel and then off to market. And then from about year 3, as production gets to the 2 million tonnes per annum, we'll have 2 barges, we'll have our own floating crane and have a more efficient operation for loading the bulk vessels off to market, and then G&A. So all up, a $42 per tonne cash cost, C1 cash cost. The cost curve. This is an important part of the story. The cost curve shows the total production from iron ore operators across the world. And as you can see, the bulk of the cost curve is made up with the major producers. BHP, Rio Tinto, Fortescue out of Australia, Roy Hill, Hancock, but also the Brazilians. And then a large number of smaller operations delivering iron ore to the export market from across the world. At a cash cost, C1 cash cost of $42, we're very well placed within that cost curve. More than 50% of the operations have higher cost than us. And when you think about the long-term benchmark price of $100, there's a significant margin between that $100 and our cash costs. And our expectation is that the prices will fluctuate over time. But as the price falls down, if it comes down to $90, potentially 10% of the production volume will be impacted. And we don't see a long-term low price much below $100. So therefore, a very strong margin for Akora above $43 a tonne. From a startup capital of around 61 million, pre-tax cash flow is very strong. You can see here that from the first 2 years of the injection of that $61 million of capital, we then get into generating good cash flow, so revenue minus operating costs, and the payback period at 1.8 years. So very good, strong cash flow. That cash flow can then be used if, as we progress through the project, additional improvement activities, but more importantly, generates the funds to enable the second stage of the Bekisopa project to be considered, and that is moving from the DSO to mining of the fresh rock to produce a high-grade iron concentrate for many decades. The annual production, this is the ramp up. We get to around the 2 million tonnes at years 3, 4 and 5, produce at that rate. And then what we've shown here is that as we do future drilling, as we have done in the last 5 drilling campaigns, drilling of the known inferred resource and convert that to indicated tonnes. Those indicated tonnes can then become part of the mining program in later years, as that's all proven up. And an additional 1 million tonnes of product, lump and fines iron ore to market, delivers an additional 21 million of NPV. So a very attractive project from that initial investment, and then ongoing drilling campaigns to convert that into an indicated resource. So very encouraging NPV flowing from the project. This slide here is the sensitivity analysis, which is plus or minus 10% of revenue, delivers plus 10% on revenue. So going from $100 to $110 iron ore price delivers 49 million NPV. Going to 120 million benchmark price for the iron ore delivers just under $100 million additional NPV. Operating costs, if the operating costs increase by 10%, so from 43 to just under 50, the operating cost impact is minus $22 million. Similarly, an improvement is a positive benefit to the NPV. We've used a discount rate of 10%, as we have in the scoping study. We believe that's conservative. Potentially an 8% discount rate could have been used. If that was used, that would have increased the NPV by $17 million. So again, it's attractive, but we've chosen to stick with a 10% discount rate. Capital costs, fluctuations, a minor impact. And as I just mentioned in the last slide, an additional 1 million tonnes of product adds $21 million to the NPV. So, significant opportunity for project improvement, enhancement of the economics over time. The PFS has identified a logistics pathway. We've included the upgrading of 25 kilometres of road from Bekisopa to the Sumanda River and a river crossing there to enable, certainly during the dry season, to get product across and stockpiled on the other side and then hauled to the port. And then in that purple line there is upgrading of that Satricala existing roadways to make them more reliable for our haul trucks to get to the Toliara port. One of the exciting and new pieces of knowledge since the scoping study is the construction of the bypass road, that green road in the image on the left, off the RN7 around the township of Toliara. So it comes down from Bekisopa, past the airport here at the coast, and then comes across, and now that makes the existing Toliara port infrastructure accessible, certainly during the ramp-up years and potentially beyond that, as the port authorities also look to expand the capacity and infrastructure at the Toliara port. So that road, which has been funded by the World Bank, brings into play the Toliara port and reduces the overall capital requirement for the Akora Bekisopa project. As I mentioned initially, we'll be looking to convey at the rate of 10,000 tonnes into barges. Those barges in the initial years will use the ship's gear, which is common practice around the world in these sorts of operations. And then as we get to the 2 million tonne per annum, we'll have 2 barges operating around the clock, having a floating crane to load those barges and make that operation more efficient going forward. The early slide showed the metrics for the PFS. This slide here is a comparison slide of the PFS metrics compared to the scoping study. 2 million tonnes, average grade of 61.6%. So same tonnage, a longer mine life, faster ramp up though, because we have more tonnes in the reserve for the PFS. 6-year mine life, so increase of 33% to the scoping study. Revenues up 45%. Capital cost is up 10%. So we've gone from 55 and a bit million to 61 million. And the main reason there is the inclusion of owners and EPCM costs. So the engineering, procurement and construction management costs of just around $6 million. A lower contingency because of the higher confidence in the numbers as we've confirmed the capital costs for the project in the PFS stage. An improved overall NPV, up 10% from the scoping study. The biggest impact on the financials in the project is the sea freight. In the scoping study, we used sea freight of $5.50. Back 15 months ago, we found it extremely difficult to get comparable sea freight for bulk vessels out of Madagascar into India or Southern Asia. We were able to get information from Mozambique, from South Africa into India, and we've factored that for future shipping costs and comparing that for Madagascar into India, and we've used a price of $14. That has had around $35 million impact on the NPV. So using the same shipping freight costs as the scoping study, the NPV would have been $182 million. But the shipping cost that we've used better reflects the current market and what the project is likely to see going forward into India, the likely market for the iron ore from Madagascar. Much improved internal rate of return. Cash costs have remained flat as we've improved the knowledge and got the quotes for the different activities in terms of costs for the Bekisopa project. Improved pre-tax cash flow and the payback period reduced to 1.8 years, predominantly because of the increased ramp up due to more tonnes available and the longer mine life in the project. One of the pleasing things, as we've spoken to before, is the location of Madagascar in terms of the world's iron ore markets. Yes, the ships can flow into South Asia and into China, for example, or Japan if that was necessary. But most importantly, accessible to India, a rapidly growing market, a market that has seen an increase in imported iron ore tonnes in recent years, but a dramatic increase in the production of iron and steel. Production increases of over 15% in recent years and forecast to increase from around 150 million tonnes to well over 300 million tonnes in the next 5 to 10 years. So huge demand on imported iron ore expected in India in the near term, and the ability therefore for a project in Madagascar to supply India is very high, particularly with the grades that we're seeing in our PFS. Lump grades of just under 62% and fines at 61%, very suitable for the blast furnace steelmaking process. The PFS gives us a pathway to the final investment decision. We've got a work plan that shows that if a number of things happen by the government of Madagascar, but also certainly by the company, we're potentially in a position in 12 months' time for final investment decision and then first shipment in the third quarter of 2027 as the project is constructed and product is hauled to the port of Toliara. The next steps include permit renewals and transformation to mining leases. One of the things that I'm looking forward to updating the market on in the near future is that Akora's main tenement, 10430 at Bekisopa, is included in the first 100 tenements that are being assessed by the Mines Ministry right now under the supervision of the World Bank with their BCMM to have those permits renewed. And once the permit is renewed, the company will then apply for mining permits immediately so that over the remainder of this year, our renewed permits will be upgraded to mining leases, mining permits as a major decision point as we move towards final investment decision in the middle of 2026. The next steps of work will also be looking at road approvals, land access from the survey work that we've done on the road and also at the port, get that further progressed and understood. The ESIA work, again, has focused a lot on the mine site and the port, but also the village areas around the mine site. The next phase of that is to focus on the road haulage route and the port areas in terms of stockpiling areas and facilities at the port. Continue the engineering works so that once the final investment decision is made, work can commence on constructing the new roads and the activities at the port. And then also with the release of the PFS, we are seeing and will see increased re-engagement with the strategic investors going forward. Up to the last couple of slides, and it's just worth noting that the PFS, not only does it confirm very strong, robust financial numbers, it's also a very key transition or improvement point for the company. We've gone from having a resource, announcing our maiden resource and resource updates, to now we have a reserve of 9 million tonnes, average grade of 53%. It's in the probable category. A lot of those tonnes are in the southern area with good grades of DSO at surface, but we've also been able to include intermediate grade material, which we've demonstrated upgrades to benchmark quality, 61, 62% iron through a very simple magnetic separation step. So that's been a very key improvement as part of the PFS work. The DSO at surface, a mine life of 6 years. These cross sections show you the extent of the significant ore body at Bekisopa. On the left-hand side, that's a cross section in the southern zone. This purple slither here is what we're mining in the first 6 years. This is where the mining will start in year one. Oops, how do I get back? Mining will start in year one. We're mining the DSO for 6 years, and then below that is this very significant fresh rock magnetite resource. In this area in the southern zone, the average grade there is 43%, and we've demonstrated that that can upgrade to 68, 70% iron with very low impurities to make DRI pellets, either for feeding the blast furnace, but more importantly, as the feed material for the decarbonisation of the steel industry going forward. Similarly in the north, this is a cross-section through the north. This is where we've drilled the deepest. These drill holes are down 300 metres. And what we've found here again is that at surface DSO, these slithers are being mined as part of the stage one DSO startup project. Then below that, we have this significant resource, which will become part of the second phase, the future development at Bekisopa beyond the DSO, producing the high-grade DRI concentrate going forward. So you can see there a many-decade operation beyond the first 6 years of this startup project. The stage two is all about making a high-grade, very clean, low-impurity concentrate for the future steel making as the steel industry decarbonises. We're already seeing this happening in the Middle East, again a near neighbour for Madagascar. Electric arc furnaces in the Middle East are taking high-grade concentrates, producing DRI pellets and feeding their furnaces. This technology is becoming increasingly available as the steel industry decarbonises, and Bekisopa, with that very extensive resource below the mined DSO, will become a sought-after product for this future world. Akora's Bekisopa project is a very compelling investment case. The stage one, which we've announced and released in PFS this week, low capital cost, very high margin, $42 C1 costs against the long-term price of 100, and very strong cash flows. And then we can use those cash flows to fund the premium grade, low impurity DRI concentrate, a long mine life for decarbonising of the steel industry. So a very compelling case. We've mentioned the board. They're here on the call today, so I thank them for all the work that they've put in over the last 15 months. Jason has been crucial as our General Manager of Development in bringing the PFS together, but with the support of Matthew and with Graham Hunt, our Chairman, We've got long experience in the iron ore industry and in developing mines, and Shane making us keep on track with the numbers. You've got a very strong board, and that's delivered a very robust PFS study. So that's the end of the presentation. Thank you all for listening, and I'm happy, Gareth, to take questions as they've been presented. Thank you.
Yes, thank you, Paul, and for the update and sharing the PFS review with shareholders. There's a number of questions that have come through over the last couple of days and into the event today. If people have questions, please log those in your Q&A section now. Excuse me. Most of the questions center around the opportunities for getting an off-taker, or who's starting to look in the data room.
Yeah.
Now that the PFS results have been published.
Yeah, look, certainly the way forward with strategics is several. Off-takers is certainly one group of interested parties. These are people who are looking to get the iron ore units and trade those, and for that they provide the finances to get the project into operation. So yes, there are off-takers looking at us, but there's also players in the iron and steel industry, existing steel makers in the Indian, Southern Asian parts of the world, and potentially in Africa as well, looking for iron ore units that are looking at the project. So a number of different possible strategic partners viewing the PFS data now that it's out.
It brings me to the next question. Now, DRI, which you mentioned towards the end of your presentation, requires a plus 68%, which Bekisopa is more than capable of producing. But are you finding that the blast furnace or traditional blast furnace steelmakers are also looking at higher purity, higher quality iron ore of the like the Bekisopa produces because of the reduced emissions and less impurities?
No, very much so, Gareth, and thank you for the question. We've focused almost on the extremes, haven't we? The DSO for the blast furnace as we currently know it, and then the DRI for the future for the green steel. One of the things that we've learnt in talking with people in the data room, strategic investors, whether they're off-takers or steelworks people, is yes, the DSO that can be mined today is suitable for the blast furnace, but they can also see a future where they can upgrade the product from the extensive fresh magnetite resource, produce a 64-65% iron product, or even better, through the crushing, screening, magnetic separation stages, produce a higher grade fines product, which can then feed the blast furnace, so make sinter pellets of a higher grade and make the blast furnace a more efficient, cost-effective operation, but also reduce emissions. So there's potentially an intermediate stage there between where we are with stage one of the DSO and the ultimate prize, which is a very clean, low impurity DRI concentrate. Absolutely.
And just talking about Madagascar, a few questions with regard to how you find it there. It's obviously emerging as a bit of a mining hotspot. If many people don't know, Rio Tinto not far away from your project, but many others. How's the environment there? Yeah,
look, as we've announced over the last, 9 or 12 months, the mining code's been updated, implementation procedures are in place. In the PFS, we've seen that bypass road from the RN7 to the Tuliara port. That's been funded by the World Bank because the government and organisations like the World Bank see that southern Madagascar is opening up to trade, particularly mining activities. There's several graphite mines in place. The Canadians are there with their mine. There's Australians there looking to develop their mine as well. The Rio Tinto project on the southeast of Madagascar. So there's a number of other mining projects in that region that are looking to access, the facilities. The World Bank and at the President's end of year presentation last New Year's Eve, so the end of December 2024, announced that the RN7, the main highway in the southern part of Madagascar, is being upgraded over the next couple of years, again using World Bank funds. So mining has picked up. The mining code, the implementation procedures, as I mentioned in the presentation, the renewal of the tenements is all happening now. So a lot of progress has been made at an official, formality level, but also that's being supported on the ground with upgraded of infrastructure over time.
The next question's a technical question, I suppose. The PFS uses rip and dig. What about adding a drill and blast scenario to the PFS to unlock more tonnes? And how long would that process take?
Yeah, look, the rip and dig certainly exposes the known indicated resource at surface in the weathered zone. Adding drill and blast, which we could certainly look to do, would bring more tonnes into the DSO category, but those tonnes aren't accessible until about year 6 onwards, as we remove the at-surface material and then got into that sort of transition from the weathered zone into the fresh rock, and there's resource there that we know with drill and blasting would become available, and then through crushing and screening and magnetic separation could become DSO fine. So we've got time. We've got time to do that. We've got time to better define the tonnage that would be created through drilling and blasting, and then put in place the necessary operational activities in terms of magazines for the explosives, and then the drilling and blasting processes as well. So yeah, look, that's we've got the time to do that. One of the beauties of the Bekisopa resource is the iron ore is at surface. We don't have to drill and blast. We just dig it and crush and screen, and we've got a product. But then, as that is mined, we have the cash to then explore extending the mine life through more drilling, but also the activities of drill and blast, like the questioner has asked, to add more tonnes. So yeah, we've got optionality, and that's one of the beautiful things that we have from a $60 million capital investment to get us going. It then opens up opportunities to look at how we can expand the project going forward.
So your next steps to consider, road approvals, negotiations with off-takers, getting leases into mining permits. Are there any more on-site sort of activities ahead for the remainder of 2025?
Look, the activities for this year are going to be focused on the procurement. So the capital costs that we need to do, so to do work on the procurement of that, work with the contractors who have provided their costings as part of the PFS, sort out who we're going to work with as our preferred contractors going forward. But then a lot of the on-ground work is the ESIA on the Bekisopa to port pathway, the haul route, working with those communities, but also further engineering, as you mentioned, and land access to ensure that we get that road built, working with the Mines Ministry and the other departments. And just on that, you've just reminded me that in the lead up to the PFS, we've had video calls with what we believe are the key ministries in Madagascar. So the roads and infrastructure, the marines and ports, and the like, Mines Ministry. There's probably another one there that I've forgotten at the minute. We've had initial discussions with them, and in the coming months we'll be visiting with them to start the engagement process so that they better understand what we're looking to do with the project and how we can work with the government to make sure that happens in an efficient and timely way.
So am I right in thinking that the cash burn won't be significant as opposed to previous years where heavy machines cost a lot of money?
Very much so. Look, we're not looking to do drilling at Bekisopa to expand the resource. We've got more than enough resource to get us busy for 6 years. All of the effort and energy is going to be on studies, minimal external contractors, unless where we need them to do those specific tasks that I've mentioned. So yeah, much lower cash burn than what you'd see if we're doing drilling to prove up more resource, which we don't need to do right now.
Well, certainly considering all the risks across the PFS, it sounds like your confidence must be lifted.
Look, if you plotted a curve from when we got listed, we went and did the magnetic survey, we did the ground geological work, and with that level of knowledge, we listed in December of 2020. Since then, we've had 5 drilling programs, further on field geological work. scoping studies, and now all of the correspondence and activities with contractors, mining, road haulage, port engineering companies. Our knowledge has just been going like this. So it's been wonderful. We're in a good place. We have demonstrated with the PFS the robustness of the project and the stability of the numbers between the scoping study and the PFS, which has been tremendous. So we've got good confidence that this is a representative study to take us forward.
Well, that sounds like a good note to finish on, Paul. We've addressed all the questions that we've received over the last few days. I hope that people found that informative and had most of their questions answered. If there are any further questions, by all means, send them to Akora's info address, and we can attend to any questions for the remainder of the week. A transcript will be going out at the end for any of those who missed it or wish to share it with other investors or shareholders. So that brings the webinar to a conclusion. I'll end the event now and leave all the rest of the housekeeping to me. Thanks, Paul.
Thank you very much. Thank you, everyone, for listening. Appreciate your support.